Hey, everybody, time to finish off estate planning, essential things you have to know about this whole world of wills and trusts. In the previous ones, I broke out the specifics of a will-based plan and a trust-based plan. Now we're going to bring together with large estate considerations and then kind of sum it up at the end here. So let's jump into the large estate considerations that we have to think about. Estate taxes are far and few between, to be real honest. We don't have to pay them too often unless you're up there in the higher net worths. So back in 2011, we increased, well, I call it permanently increased the estate tax exemption limit to $5 million per person. And we put it in the code that we have to increase it to inflation every year. And the reason this was this is very significant when this happened, is because before that, it was something that they negotiated from year to year to year. It was on the table every year. Now they just put it in the IRS code. They went in there and said, well, here, it's on the books. So the way they're going to have to change it is by passing a bill or legislature. So it is different this time. So back in 2011, the ramp up to 40% taxation is very quick. So let's just call it 40% taxation on anything you have beyond $5 million. And then every year the IRS increased it to inflation. Okay. Then we had a tax act pass, a reduction of taxation. We all like less taxes, right? And they also slipped in the doubling of that estate tax. So since 2011, the individual estate tax exemption has grown to just over 6 million, and we're under temporary doubling, which gives us currently an individual estate tax exemption of over $12 million each. And the other thing that they did back in 2011 is made it portable, meaning if you have a spouse pass away, the surviving spouse can file a form with the IRS and inherit their exemption, essentially doubling their own. So theoretically, one spouse could have over $24 million exemption from estate taxation. So estate taxes, you definitely have to have quite a bit of money. Most people all know about this annual gift exclusion too, okay? So right now we're at $17,000. So that's 2023 is $17,000. You can give as many people as you want $17,000, and there's no penalties, there's no reduction of your lifetime exemption, there's no taxation, just hand money over, and you don't have to file any forms or tell anybody anything, as long as it's 17,000 or less, okay? If you go over 17,000, then you will have to report it, but that'll just reduce your lifetime exemption. Okay, that's all. It doesn't mean it's taxable to the recipient. It's not taxable to you. You can write a check for as much as you want, as long as it's less than $12 million right now. There's no issues. Okay. They also have exclusions adjusted to inflation, which we already talked about, but state deductions for family-owned businesses. And if you owe state estate taxes, they have exemptions for that as well. Let's look at those states. So I have them listed out here, and I always say there's a couple of states that are pretty smart, all right? And the rest of them are terrible and not smart at all. So the first thing to understand about state estate taxes is, for the most part, the concept is the same as the federal estate tax. If you go over a certain limit when you pass away, then you're going to owe some taxation on that amount above. But there are states that just write their own rules. So every single state is going to have their own little quirks about their estate tax, or what you'll see in here is even inheritance taxes. So each state is going to have its own rules, and you've got to look into the states that you're in. So how do you know which state you're in? Well, it's always going to be dictated by your primary residence. Okay, so look at your driver's license. Look at the address on your tax return. That is the state that will most likely successfully call you theirs. right? So if a state can claim you as a resident of their state, a primary resident of their state, then they have control over your entire estate and are allowed to tax it. If it's an investment property or a third home or a second home or whatever, if it's not something you're utilizing as a primary residence, again, this is real property. Real estate is always the first thing they're going to. If it's real estate and they can't prove that that's your primary residence, then they can only tax what's in your state. So let's look at some of these. One of the smart states right here, Connecticut. We're starting off right off the bat with a smart state. Here's the reason they're smart. And this is what's important to see here. They are smart because they're matching federal. And federal gives a dollar for dollar tax deduction for anything you had to pay for the state. So if the feds want 40% from you and the state wants 12%, you're not paying 52, you're only paying 40. You're paying 12 to the state of Connecticut and you're paying 28 to the feds. So Connecticut is being smart. They're not upsetting their residents by having an estate tax. They're just matching what the federal has and stealing some of the feds' money. That, to me, makes sense. Why doesn't every state do that? I can't answer that question. There are not a lot of very smart states out there. So that's why. Why not just put it right on the books that we will match federal, but we want 12% of it, or 15, or 20, or all 40. That would be even smarter. Take all the feds' money. So DC currently has a $4 million exemption with some caveats to that, apparently. Hawaii at $5 million, Illinois at $4 million, Iowa, just get out of that state. They have a weird inheritance tax. Make sure you read their rules. Kentucky, same thing, get out. Maine, $6 million. Maryland, $5 million. But Maryland also has the inheritance tax. So get out, run. Massachusetts only has $1 million exemption, meaning every penny you have over $1 million, you may have to pay that 16%. So you may want to run from there scared quickly. $3 million in Minnesota. Nebraska is only $10,000. Weird little inheritance tax. Read the rules carefully or get out. New Jersey, just get out. James Gandolfini had really good lawyers that apparently didn't know the rules in New Jersey. And when James Gandolfini passed away, his estate lost a ton of money to taxation to New Jersey. So be careful about these things. Even with lawyers, sometimes they don't understand these laws. So get out. New York, $6 million. Oregon, only $1 million. If you pass away in Oregon, let me move my head here, you got 16% taxation you're going to have to worry about on everything over $1 million. Pennsylvania, get out. Rhode Island, only 1.6, get out. Vermont, 5, and Washington State is a little over 2.1 million there, and they actually have the highest percentage. It's a 20% tax. Sorry about that. 20% tax in Washington State on anything over the $2.1 million in Washington. So be careful about those states. You need to know what you're doing and have good attorneys that can address this taxation. Otherwise, run scared and move to a better state. If your state is not on here, like I'm in Arizona, you don't have to worry about state estate taxation. You just have to worry about the federal estate taxation, which again currently is at over $12 million per person. So a married couple is $24 million. So to sum this up, you have to have documents, you have to have a plan, and it has to be thought through, okay? So a will-based plan or a trust-based plan, you got to have one of them, and you got to have the documents in there. In both plans, you have to have living wills and you have to have your power of attorneys, okay? The last will and testament, really all that is supposed to take care of the stuff, not your house, not your car, not your money. It's only supposed to take care of things like furniture or jewelry or antiques in the house, things like that. Name a personal guardian, okay? Trust-based plans, you're creating an entity, okay? You're putting yourself in charge. You're writing a document that says what happens while you're alive and well, what happens when you're incapacitated, and what happens after you pass away. And you're putting somebody in charge when you can't be. You're naming them the CEO after you're gone. You're the CEO of this entity while you're alive. So that's the concept of these two. Not everybody needs a trust. So when we kind of look at the essentials of all this, you got to create your documents now. If you haven't, you got to have some basics. Otherwise, you're going to leave a disaster for your heirs. Okay. Now, I've met one person that purposely wanted to leave a disaster to their heirs, but most people don't. Most people just don't want to be a burden to their heirs. So will-based plans are best for most if you are in a state that allows a beneficiary deed. If you don't know what I'm talking about on a beneficiary deed, go back and watch my will-based plan. I think it was part 2 of this series. That is important. If you are in one of those states that allows beneficiary deeds, you can pass your real estate through a beneficiary form on the ownership documentation on your house. And if that's the case, you can do that same thing on all of your monetary accounts. And in a lot of states, you can even do cars that way. So the reality is that a will-based plan for most simple situations is the simplest and easiest way to get your stuff to your heirs as efficiently and cleanly as possible. That's my favorite way to clean up a passing of somebody, is going in on a will-based plan, sending the death certificates everywhere, and the money just gets sent and you're done and you move on. And you don't have to scream and yell at somebody in charge of your trust for not doing their job. Okay? So, big key to will-based plans is your beneficiaries. You've got to go through everything of value and make sure that you've got beneficiaries listed properly. Every monetary account should have a beneficiary listed, or multiple beneficiaries. And they should have proper information. The birth dates should be correct. The social security numbers should be correct. And oh my Lord, the spelling of their name should be correct. We've seen so many problems out there because of lazy advisors or whatever the case may be. Whoever's filling out these beneficiary forms on these IRAs, these Roth accounts, these non-qualified brokerage accounts, these bank accounts, these kids that are working at banks. We can put beneficiaries on any monetary account out there, and you should. You've got to have that done properly, especially in a will-based plan. Save money, use the internet, have a knowledgeable financial advisor. That should make this whole will-based plan very easy, especially on your heirs, because your heirs can call that good financial advisor and say, hey, mom passed away, I need help, what do I do? And that financial advisor doesn't charge like an attorney. They're going to have some self-interest to preserve the money under their own management, which means they have motive to help your heirs out. Okay, so there is some simple logical reasons why a good financial advisor is really worth it later in life. And I always tell people you need a good financial advisor, especially as you transition into retirement and then when you transition out of retirement. Those are great times to really have those good financial advisors that are there to help genuinely. So, utilize a trust in the following common reasons: large estates over the federal exemption limits, or even the state exemption limits. For instance, my parents are in Washington and Washington State, and in that state, anything over $2 million is going to get taxed. So they have reasons to make sure that they've got a good estate plan that will help them avoid some of that taxation. So, real estate in non-beneficiary deed states. Okay, that's important. You need to know what states allow beneficiary deeds, meaning you can put it right on the ownership paperwork that are recorded at the county. Who gets this house if you pass away? And that way it doesn't go through probate, and that's what's going to save you on this plan. Family businesses. If you own a farm that's going to live on after you, you need a trust. This is messy. So make sure you have a really good attorney that does a very detailed job on that trust. And then difficult family dynamics, maybe a special needs kid, maybe 72 heirs all splitting 1% and a couple with 2%, just craziness. If you got weird stuff going on, sometimes the trust makes it easier to handle that. And if you do get a trust or have a trust, please fund it. Fund it means everything that can be owned by the trust should be owned by the trust. All your real estate should be owned by the trust. All your bank accounts should be owned by the trust. All your brokerage accounts that aren't IRA or Roth should be owned by the trust. These are all very important things, because this is why I see as many people in probate that have trusts that have wills. You end up in probate when you make the same mistake with either plans. You forget a beneficiary, you forget to change the owner, you forget to do something on one account, and all of a sudden you end up in probate. Okay? Now, some states have simplified probate process for basic, easy ones, but also some states, even that process takes a year or two. I'm hearing some states are taking multiple years just to see the case. It can be messy. So avoid that. Do it clean, do it easy. Simplified is always going to be better. All right. Hopefully that helps. This is the basics of estate planning that everybody needs to know, no matter what your net worth is, no matter what age you are. We got to have at least some form of a plan. And sometimes a good advisor helps out with that. So give us a call if we can help out in any way. I'm always happy to chat through this and kind of figure out from 10,000 feet what your needs are. Shoot us an email, give us a call, like the video below, comment, check out the verbiage below. Sometimes there's some links for free reports and stuff like that. Always got some good stuff out there, and always happy to help. See you next week.